We're here with the great guys, Shane Brunette and Harrison Dell from Crypto Tax Calculator. We're going to talk about all about the intricacies of tax and crypto. Shane, it's great to have you on board. Tell us about yourself. How'd you get into crypto?
Yeah, so I started out in crypto back in 2015, got introduced to this thing called Ethereum back at another startup I was working on. Kind of played around with it for a long time, and like a lot of people, got myself into a fairly serious crypto tax situation. I thought it was really hard at the time to try to work it out. Being a software engineer, thought I'd just work on this project, be a weekend. 5 years later, we're still here trying to solve the problems. But yeah, built out this software called Crypto Tax Calculator, Australian-made software, built from the ground up to follow the rules of the ATO tax guidelines. And really happy to be here today.
And phenomenal beard as well. Harrison, welcome to the show. Tell us about yourself.
Thanks, Fred. So myself, started at the dark side. I was a tax lawyer for the ATO. That's where I got my chops in crypto tax. I started there in 2017 and kept saying yes to this kind of work, doing great stuff for a lot of clients, a lot of very edgy stuff. It's very interesting. So much so that I've started my own tax law firm called Cadena Legal, and I do a lot of work with Shane and the Crypto Tax Calculator guys because this stuff's hard, as we're going to see.
Amazing. Now, what we're going to do today is we're going to get into a lot of intricacy around crypto and tax. Now, there's a lot of questions around this, and we're going to go and really, these guys are like the experts. We're going to unpack these things. Now, I just want to flag, this is not financial advice. This is not tax advice either. This is just pure opinion and educational information. So just had to make sure everyone's on the same train with that. All right, guys. Now, here's the thing. We're going to go into a few different transactions. There's a lot of transactions out there. Let's go and unpack each one. I would like to start with capital gains tax events. Let's unpack a few of these. So, can you talk us through, like, when you make a crypto to fiat transaction, what is that and how is that treated in terms of tax?
Yeah, so I think a lot of people think, tax, it's just something that when you cash out of the crypto system, that's what's going to be taxable. And that's not actually the case. When you're actually trading crypto to crypto, that can be a taxable event. And when you're pulling money straight into fiat, that's also a taxable event. So you've really got to think about all the transactions that you're doing in the crypto ecosystem and not just like one particular type of transaction, such as the money getting pulled out into your bank account.
So when someone takes something from crypto to fiat and there's a capital event in that, so that they're taking money out, how is that treated?
Yeah, so if you think about it, what did you buy that crypto for? And it's not as simple as thinking, I put $1,000 into the crypto ecosystem, I took $2,000 out, so there's a $1,000 gain. You've got to think about all the transactions that you did while in crypto in the first place. So if you bought Bitcoin for $1,000, but then sold Bitcoin for like $3,000 for ETH, and now ETH has gone down, and now you're cashing out $2,000, you might have a very different tax outcome to what you thought about, because it's not just cash in versus cash out. It's like, actually, what was the cost basis when you bought that crypto, and then when you sell it, that difference is what the gain would typically be.
Okay. Now, there's another intricacy on this. So if you've got, that's crypto to fiat, right? Let's talk about now, let's say I've got crypto and I buy another crypto. So you talked about Bitcoin to ETH just then. Or let's say you took some crypto and you bought an NFT. How's that treated?
Yeah, so if you think about it, when you buy Bitcoin, for example, that might have an initial price point. Say it's $1,000 when you bought it, if you're lucky. Then when you go and sell that for ETH, there's going to be a market price. And that market price is what forms the proceeds, they call, in tax. And that's the kind of revenue that you're making from that sale, minus the cost basis, which is what you bought that particular crypto for. And so you've got to think about what the market price when you're actually buying the crypto and when you're selling it. Obviously, it's really hard to work out. It's just not as simple as just looking at your cash account or, your bank account. And that's where, you probably want to be using software for something like this.
So what about in terms of a disposal? So everyone talks about this disposal. What does that mean?
So when you're talking about CGT, there's two main things you've got to have. You've got to have an asset. In this case, we've got crypto. And you've got to have an event. Most common event is a disposal. Disposal could be sell it for money, sell it for crypto, or I gift it to somebody else. And sometimes I lose it. Someone steals it from me. When you go, okay, I got Bitcoin, I bought it for $1,000 worth. It then went up to 10,000 and I swapped that Bitcoin for Ethereum. I've had my CGT asset, my Bitcoin, and I've got my event at disposal. So that 1,000 realizing at 10,000, but not to cash, still becomes a capital gains tax event. You made a $9,000 capital gain. You might have a few more costs to throw in, a bit of gas, a bit of trading fees. But you've got to think about, I've just still got that economic exposure, but I don't have any cash in my account. If ETH then goes down, you've got a real problem, especially as we approach 30 June. You've got to think about realizing those losses, realizing those gains. And when you do, stay on top of how much is this going to cost me.
Okay. Now, let's go into a few details. So that was really about capital tax events, right? So now let's go to the next one. We've got about income. So maybe we should talk, so what's the difference here between these capital ones and income when it comes to crypto? What are some examples?
Basic example, of capital we've already gone through. It's just a basic sell, realizing an investment. Income, there's 3 kinds of income. There's income from business, income from property, income from exertion. So if you're working, getting paid in Bitcoin, that's income. If you're in business, so you earn, a supplier, a client pays you in crypto, they do with me sometimes, that's income as well. I need to report that. And the last one, income from property, is what a lot of people are actually going to be receiving. Things like staking rewards. If I'm going to stake some cake tokens or some ETH or whatever it may be, what comes in, that's income. It's as simple as that. But the really hard sort of question is, when you start trading as a business or doing more complicated activities, it's a super grey area. And it's not just crypto. It's a question of carrying on a business. What does that mean? It's a hard question.
So let's talk about this grey area, because I think, Harrison, something you talk about, and a lot of people have this question, I just sort of pick up on this, is can the ATO track your crypto?
Well, think about it this way. All the exchanges in Australia are under notices to provide the ATO with information about your activities. They have to do that by law. Whether the ATO uses that or not, we don't really know yet. We've seen some audits start. The ATO has it in their sights. You may think, when I go off exchange and I go use my MetaMask or I go use my Solana wallet or whatever it is, ATO can't see that. But there's clearly a transfer from the exchange to your wallet. That information is out there. Once you're doxed, it's all there for the ATO to see, everything you've ever done. And I think in the future, we're going to see the ATO catching some people out who thought they were anonymous. And then they can see 10 years of Bitcoin trading history and there's millions of dollars to pay. I'm seeing a few clients start to have those wobbles and they get very concerned, because once you get doxed, everything's out there.
Interesting. All right, let's get back to now this income tax, and let's go through some items, so types of transactions. So there's lots of types of transactions when it comes to crypto, and let's go through each one, because I think there's some intricacy in here, and I think helping us understand those, I think, is really important, and would love to understand them. So let's go first one. Let's say you get a staking reward. Let's say you get some ETH and you put it into a node. You get 32 ETH, and you become a validator. How's that treated in terms of tax?
Yeah, so there's still some open questions around that, but in a lot of ways you'd think about the rewards being treated similar to an interest in your bank account. That's the easiest way to think about it. And at the time of receiving those crypto rewards, they've got a market value. That market value is treated as income for tax purposes. It's probably the most reasonable way of viewing it. And a lot of people think, does that mean I get double tax? You kind of see that question come up a lot in Reddit. And it's really important to note, if you earn $1,000 in income in crypto, well, that actually forms the cost basis for your future sale. So then if you go and sell it for $2,000, the gain is only $1,000. You've got $1,000 income, $1,000 capital gain as well. So there's this distinction between income versus your capital account, they call in the tax world. So again, you really want the software to kind of keep track of that, to kind of make sense of it, because it's a total nightmare otherwise, especially if you got staking ST ETH, for example, and it's rebasing every day and you're getting those rewards every day and trying to work out the market price every day and keeping track of what the cost basis is of that ETH that comes into your wallet for when you sell it, because you've also got to think about the gain there. So yeah, really complex, but easiest way to think about these staking rewards is probably similar to miscellaneous income, like a interest in your bank account.
Okay. Now, this is obviously different in terms of staking, because you can stake in nodes. There's another type, which is, we're going to just sort of highlight this as a farming reward, where you have potentially staked in an AMM, automated market maker, say like Uniswap. You've put some USDC in, maybe some ETH, and you get paid some farming rewards. Let's call those native tokens as an example. How is that treated?
Yeah, so I mean, the actual token, when you receive it, again, it's kind of forming into this kind of income bracket, arguably. And, the thing that you got to think about here is, well, you're receiving this income. You might have, for an extreme example, received $100,000 in these tokens in income. And now these tokens, they go down in price, they're volatile. Maybe this particular token that you received has collapsed to $0, like it didn't have much intrinsic value in the first place. It was just a bit of an incentive at the time to try to suck liquidity into the system. And you've got this $100,000 income, but $0 value of the asset, which would be a capital loss of $100,000. But you can't offset that capital loss against your income. You can only offset it against, this year's current capital gains or future capital gains. And so that's where like a lot of, crypto participants can get really caught out, where they've got these different types of tax treatments for different types of tokens, and they actually got, more tax than what they even own at this point in time. But there's also like quite a bit of complexity there around adding the liquidity into the liquidity pool as well. So maybe...
Yeah, so the AMMs, staking is sort of a broad term. Sometimes that means you're actually staking ETH and generating new ETH in an actual validator. Sometimes just locking it up in a smart contract and you'll get more of whatever sort of thing you've invested in. The names are kind of quite confusing, and I like to think about all these kinds of things as you're interacting with a smart contract and what does that mean for you. If I put stuff into a smart contract and then I get more stuff out of it, you got a question of whether that's income. That difference, whether it's paid in or paid out to your wallet directly. If you're exchanging, Bitcoin on the Bitcoin network for wrapped Bitcoin on Ethereum, you go, well, I've used a smart contract. What does that mean? Is that a capital gains tax event? And this is like really basic stuff that we haven't got that clarity from the ATO. I'm doing a lot of work with them to help them sort of give that guidance to the community. Hopefully we're going to see some of that soon, but we haven't got it yet. And even when we do, the ATO isn't going to be able to consider every single kind of smart contract there is and say, here's what that means. You've got to take an informed decision. CTC does some of that thinking for you when it says you've got receipts here. This looks like income. And you can change what you're going to treat it as. And my advice to everyone, no matter what you're going to do, whether you're going to take an aggressive position or be conservative, is to at least be consistent. If this kind of thing is income, keep it as income. What the ATO is not going to like to see is if you go, this is income, oh, now it's a loss. This similar thing, oh, we're going to say it's, free crypto as a gift. When you're inconsistent, you're raising your risk dramatically. And coming all the way back to staking, you've got to ask the question, am I getting crypto from it? Is that income? And if you're receiving stuff, it probably is. There's always an argument, but this is where you need a specialist to help you out.
Understand. Okay, let's go into another intricacy about yield rewards. Again, a different terminology, but let's say, we've got recent examples with BlockFi, Voyager, and where we've got these centralized services that you deposit your coins into, and then you receive a yield. But in some cases, people are still waiting for those coins to come back. They've not been able to receive them back. There's obviously a lot of ongoing court proceedings currently happening around this. How should people try and treat that?
Yes, I think there's a few different issues there. Like if you're depositing into a centralized facilitator that's paying out a reward, is that really a deposit or is it a disposal? And we don't really have very clear guidelines from the ATO at the moment around that, unfortunately. There are regulators around the world who might very well, they've come out and said, actually, this is a disposal. And there's some other tax authorities around the world who are saying, oh, no, it's more like a deposit. So it's more of a wait and see from the ATO in that regard. But there's also, if you're unfortunate enough to deposit money into Celsius, you've been earning these yields or whatever, but never got anything out, because they're going bankrupt, there's a whole level of complexity there where you really, actually the bankruptcy rules, they're quite nuanced. You probably want to be, getting all those records in place in the first instance. We've actually, on that point, FTX, for example, that went under. If you weren't using a software like Crypto Tax Calculator, how are you going to get your records? Because they don't provide them anymore. So there's a lot of kind of importance of making sure your records are up to date in case something does go under. But if it does go under, that's when you want to be talking to your accountant or a tax lawyer, et cetera, about, the bankruptcy and how that actually works, because it's quite complex, isn't it?
It's extremely complicated. The insolvency tax rules basically relate to companies. You own shares in a company, it goes down, what happens? There haven't been many cases pre-crypto where there were, people holding your stuff and disappears on this sort of scale. So we've got FTX, we don't even know what's happening there. That's going to take a very long time. And the question that I get asked is, can I claim that as a capital loss now? And the answer is, we don't know. Likely no. I'm working with the ATO to try and get them to agree to allow people to take the loss now and clean it up later, but we haven't got that confirmation yet. I've been working with some other financially challenged institutions about engaging with the ATO to make sure that the customers know what the tax outcomes are. We've had some interesting deals go through on some insolvency matters, and we've got overseas insolvencies. Like, this is really complex stuff that regular users wouldn't really come across except in this space. Like, this is a real tax law question, and most people shouldn't need to talk to me, but unfortunately, they really do, especially if there's a lot of money involved.
Let's talk about, so we talked about depositing into a smart contract. I think it's really interesting you're saying it could be potentially a disposal. And coming back to you, I think it's a great point. Let's stay consistent in terms of and the way you report. And then, I think it's a great point. Let's talk about another intricacy, go a bit further. Talk about wrapping. So let's say you have some Bitcoin on the Bitcoin network. You wrap it into some wrap Bitcoin, maybe with the REN protocol or other forms. How's that treated? What should you consider there?
Yeah, I mean, like from a technical point of view, you're kind of, you're upgrading that token so it can do different things. But then from a law perspective, it gets a bit more complex. And there's an argument to be said that, that could very well be a disposal because this asset is, it's got different functionality. It behaves differently. Like the Bitcoin on the Bitcoin network is quite different to, an ERC20 wrapped Bitcoin. And so maybe that is a disposal, but then there's other arguments to say that perhaps it's not because, they're both representative of the same symbolic asset class, which is Bitcoin. And so maybe you want to talk about that a bit more.
Yeah, look, I get this all the time because the question is, do I pay a lot of tax or do I pay no tax on this transaction? Especially if you've had Bitcoin for a long time. It's a very serious question. This isn't a few dollars and cents. I've seen hundreds of thousands, millions of dollars. The Bitcoin to, the Ethereum network, there's always a thought, well, this is a new asset. But even the original Ether, you had to upgrade that to ERC20 variant. And that protocol upgrade, it's not clear whether that's a taxable event. There is some guidance, which is about 30 years old, relating to shares, and you change some rights with some shares. It doesn't trigger a capital gain. It's still the same share. And I've been trying that argument with the ATO with varying levels of agreement, but we still don't have anything. And this is really the message to get out there. And I'm not trying to scare everyone, but there's just a void of information. We don't have it yet. What the ATO is going to do with it, we will hopefully get it soon. But in the meantime, you need to be careful on these positions. And the wrapping one is a really big one. It can change your tax report from hundreds of thousands paid to zero. And if you're going to go towards zero, you need to make sure you got a strong position at least.
Okay. Let's talk about another transaction, another intricate one. Let's talk about bridging. So let's say I have a stablecoin on Ethereum and I bridge it over to Arbitrum as an example. What kind of tax events or things should we consider here?
Yeah, so I mean, bridging's like really interesting, I think. It gets into like this kind of where the tension is around, is this a disposal or not? And you could, you've got wrapped Bitcoin where you send Bitcoin to a protocol and then now it's on the ETH network, for example. So they also call it wrapping, but it's really a bridge in a lot of ways. And if you think about it, like it is kind of representing the same asset, But in another way, it's kind of like quite different. You could do a lot of things on, Arbitrum that you couldn't do on the Ethereum network. So it's one of those things where we're still waiting on the guidelines, like how the software actually handles these types of situations. We'll go through and label these. So look, this is a bridge, or this is a wrap, etc. And then you can actually configure it so that it is consistent and, like treat all wraps as disposals or treat all bridges, as transfers. And then it actually is consistent so that, if we do get guidelines over the next year and they change, you can easily go through and amend that if necessary, as there's more information that comes out. Or, in the event that we get no guidelines, at least if you get audited, you can say, well, look, this was, my best guess at how this should be treated, and I've done it consistently throughout the entire time that I've been trading.
Awesome. Let's pick up another point here. So we talked about Arbitrum, and with Arbitrum's case, there was a recent large airdrop. Let's talk about airdrops for a second. How should people think about airdrops and the construct of them from a tax perspective?
Yeah, super interesting. Like, again, you've got this concept of receiving tokens and they're treated as miscellaneous income. What's the market price at the time of receipt? That's the way that we used to view airdrops. But the ATO, they actually came out with recent guidelines last year around, this concept of a token creation event. And so with Arbitrum, they were creating that token. And at that initial point where you initially receive the airdrop, you could argue that market price was zero because there was no market. They're just creating it. And so they're kind of treating it a bit like a chain split or something like that, where it's an actual creation of this token. And in that case, perhaps the cost basis is zero, and that when you go and sell it, then the entire value is taxable. But when you receive it, it's not actually any income because the price was $0. But if you were to say receive Arbitrum today as an airdrop, when there is a clear market and a clear market price, I think that's very clear there that that's an airdrop which is taxable, and that's actually income. So if you paid me and called it an airdrop, it's probably income actually.
Okay, thank you, that's great. Let's talk about some intricacy that's happening right now. So it's coming into, anyone's coming into an end of financial year, and there's this concept of realising losses. What are the intricacies in the Australian tax system around realising losses?
Yeah, I really like this question actually. There's the wash sale rules, and you go on Reddit and you hear all these things about wash sale rules and how in the US, you don't hear this part. In the US, maybe wash sale rules don't apply. But in Australia, that's quite different. And you've got to understand the community around crypto. It's a global community, but this is an Australian tax system. So maybe, Harrison, do you want to talk about wash sale rules? Yeah,
look, there's a lot of technical stuff to get into, but I don't want to dig that out here. But there's no period of time where it's safe, basically. But because it's so unclear, it means you've got a bit of a grey area. And I like to say, you know it when you see it. If I'm going to sell my Bitcoin or my NFTs that went down massively this year for a loss on 30 June and then rebuy them the next day, then that looks awfully fishy. And you need to be very, very careful. Leaving a period of time is going to be a much better way to approach it, and documenting your thought process. So if you sell Bitcoin on 30 June, because that may just be a good time to sell, it may go up to 35,000, 40,000, we don't know. And then on 1 July, it drops massively for whatever reason, you might want to say, I've changed my mind about it. This isn't a wash. I'm thinking it's a better outcome to now buy it. And now it's time to buy. And look, the ATO isn't particularly active on this, but it's a rule to be aware of, because when they see it and it looks fishy, they are going to chase it.
Yeah, I think that the one thing that we see a lot in the market is, at the end of the tax year, I'll just sell everything, work out what, my tax position is based on everything I sold, and then I'll just rebuy my portfolio the next day. And those kind of really simplified views of how to do your tax, they actually don't work because of these wash sale rules.
Yeah.
And so you just got to be thoughtful about, what are you actually doing? Is the motivation behind this an actual disposal? Do you intend to actually dispose of this asset, or are you doing it to try to, tweak your tax losses and you're hoping to buy back at some point in time? Are you doing it to like simplify your tax calculations? Like none of those ideas actually work in Australia.
Okay. Let's get into sort of a last point. There's a lot of wallets people have, and every now and then you get these unusual tokens dropped into your wallet that are worth $1 billion. And people could think, that they've made a big potential gain in some way, shape, or form. Tell us about how should we think about those, and what's important when it comes to those kinds of coins.
Yeah, so when you come look at this income, that you're receiving in free tokens or whatever, you haven't paid anything for them, they're just getting sent to you as an airdrop or something like this. You got to think about, okay, what is the value of that token? And you work out, well, what's the market price? And for a lot of these, scam tokens or spams or whatever, there isn't actually a market price. So you could say, look, it's zero, it's worthless, let's just ignore it. Don't worry about it. There are instances where you might receive this token and it's been manipulated. Like there isn't really a market. There's like liquidity of like, say, 10 of these tokens, and somebody's, pumped up the price a little bit on a decentralized exchange or something. Now all of a sudden this token has $1 million value, but it only had $1 million value for like a couple of minutes. And so, what's the actual market price, or is it manipulated? That's also a question which you can think about and argue for. Like the real market price of this token might still be zero, even though there's very little trading volume on it.
Okay. So I think there's a wonderful things to sort of wrap up, Shane. When it comes to these kinds of intricacies, what benefits do you think there are with crypto tax calculator when it comes to these kind of challenges?
Yes, I mean, we're built in Australia. We're made, considering Australian tax rules, the ATO guidelines at the time. We work closely with, partners like Harrison Dell, accountants all across Australia, H&R Block Australia. So I think if you're going out there thinking about crypto tax, thinking about how to do your taxes, you've got to be going to a software solution. Like it's just too hard to be doing it manually. You can't do anything in crypto with paper. It's all technical. It's all on the internet. There's no difference here with software. If you're going to be your own bank, you've got to keep your own records. Crypto is inherently decentralized. There isn't any trusted third party to give you those reports. And so when you get these reports, you need to use something like Crypto Tax Calculator to generate these reports in the first place. Trust something that's Australian for the Australian tax system. And with our software, it's quite easy. All you do is add in you've been trading on a major exchange, add in the CSV or the API keys. If you've been trading on-chain or anything like that, you can plug in your wallet addresses, your public wallet addresses. So there's nothing private that you have to give away there. It's all public, public wallet addresses or read-only API keys. So there's no risk of funds. Just put that all into the system. That will pull in all your transaction histories. And we actually go through protocol by protocol and actually try to work out what are the interactions, try to label them accordingly. We can't cover absolutely everything, so there might be a few questions there, but we try to give you the right amount of information so you could be really confident that in the time, if you are unfortunate enough to get audited, that you've got the records in place. You could show a consistent way of doing these calculations, and then you could go take this, you essentially take this download pack. It's like you could give that to your accountant, or you get your MyGov report, plug that straight into MyGov, depending on how you're filing your tax return. So.
Wonderful. God, thank you so much for coming on the show, and also for being so educational and helpful. It's been incredible, very enlightening. Harrison, thank you so much. And Shane, thank you so much for coming on the show.